G'day, hello, Joel Seach, Harpel Financial Group. Morning, afternoon, or evening, whenever you may be watching this video. Hope you're keeping well and keeping warm if you are in Melbourne in the Melbourne winter, or if you're on holidays or elsewhere in Australia, like I know a few of you are. Hope you're enjoying it. Mainly reason today is to catch up, just to quickly go through a quick summary of the recent market volatility we've just been experiencing of late, especially the last few months and the last few weeks as well, with the topsy-turvy nature that we've experienced even from the start of this year with the ups and downs. It was mainly just a quick video just to sort of go through, explain a bit about it in terms of where it's coming from. So it's sort of derived from inflation numbers picking up around the world as a main, the cost of goods going up, and also some issues with supply chain dramas in terms of wars in Ukraine and just issues of cargo getting in and out, etc. So all those things boil up to cause this overheating of inflation. A little bit of inflation is okay, and the government or the RBA, the Reserve Bank of Australia, is quite happy with a bit of inflation, usually a band between 2 and 3%. When it gets too high, it's not good for anyone because it creates uncertainty around the marketplace, e.g. going to get an iceberg lettuce a month ago might have cost a couple of bucks, and now it's $11 or $12 I've seen in some shops. That's a different supply chain issue as well. But inflation, in a bad way, if it gets too high, can cause this uncertainty. And people don't like uncertainty. People like sort of some confidence. They know they're going to go to the shops. There'll be things that they need at a similar price to what it was last week. So 2 to 3 band per year is a perfect amount for inflation. The RBA governor, so Dr. Lowe, came out last week just explaining that they're expecting inflation to peak at around 7% towards the end of the year. Slight forecast increase from 6% the previous meeting minutes. So peaking around 7%. And that's on the other hand with the RBA raising rates. So the reason they tighten monetary policy and increase the rates from 10 basis points to 35 basis points to another 50 basis points to 85 basis points. They're trying to increase the cost of borrowing to help slow down that inflation rate. So people are potentially borrowing a bit less, businesses are borrowing a bit less. So it sort of helps that that aspect of making money a little bit more expensive to borrow with interest, etc. Now, on the other hand, that helps out with some investments because interest rates go up, and that can be a good thing for some investments too. In terms of the market taking a bit of a hit recently, the market doesn't like so much uncertainty, a bit of inflation coming up, and the market sort of factoring in that they thought interest rates might have been lower for longer. Companies were making better profits potentially when the interest rates were lower, so that'll slow things down a bit. What the market wants to see now is inflation to begin to get under control. So when the rates go up or interest rates go up, the market can hopefully see there's some confidence that inflation hasn't gotten out of hand and it's still in that transitory mode. So that the thing we don't want to see is inflation set in and be harder to get rid of. So that's why the markets have been reacting so volatile lately, is really due to those main factors. So just wanted to, I guess, explain a bit about that with you. And probably the other thing was just to share some graphs in terms of useful information that I thought might be helpful in relation to going through a few of the moments we're going through. So this one here is just a graph of the S&P 500, which is the top 500 stocks in America, in the Dow Jones, from 1929 to present. And it talks about the probability of a negative return based on the top 500 companies' total returns from 1929 to present. So what it means is that the probability of getting a negative return, if you just held a basket of stocks for a day, your chance of getting a 46% negative return. If you held a basket of those stocks for a month, there's about a 38% chance of a negative return, a 62% chance you'd make a positive return. Then it goes on so forth, 1 quarter, 1 year, 3 years, 5 years, and then a 10-year hold. There's only a 6% chance if you held at any period of that time, but 10 years, there's only a 6% chance it'll be negative. There's a 94% chance that it would remain positive. So when we talk about time in the market, that's what we talk about rather than trying to time the market. It's more about making sure that things are consistent, methodical, and well diversified over that period of time to allow those negatives to start to subside. The longer we're in something, there's a lesser chance there's going to be any issues. The other good slide that I came across, this one here is a very colorful one. This is just talking from 2010 to 2020 about all the different investments and ranking them from the best performing to the worst performing every single year over the period of time. So it talks about a range of different investments, and that's why we do spread a portfolio, because not everything will do the same job every single year. So things spread around, and there's a bunch of different colors in there because all the different asset classes are featured over that period of being the best and the worst performer. But the actual slide I wanted to explain was just the erosion of purchasing power. So essentially, if you sat on the money and just put it into a cash area, then the actual purchasing power of that money decreases over time, which is the reason we have growth assets in our investments, and we have shares, we have property, we have infrastructure, is to help money keep pace with inflation, so that when inflation goes high, we're not tracking too hard behind that. And the other interesting thing is the compound interest is your friend. So growth of $100,000 returning 10% over a period of time, over 10 years, 159, over 5 years, 61. So time in the market and making sure that money works for you is the really important factor. And the other really interesting slide, and this is probably the one I wanted to share the most, was the time in the market versus time in the market. So missing the top performing days can hurt your return. So a hypothetical 100,000 again in the S&P 500, so the top 500 stocks index in America, over the past 20 years, from 2001 to 2020, if we had that money, $100,000, and stayed invested over that period of time without chopping, changing, moving out, pulling in, that'd be worth $424. If we miss the 5 best days, it goes to $268. So if we've chopped out, we've moved it out and moved it back in, and we've missed some good days, it's down. We missed the 10 best days, the 15, the 20, the 25, we're worth less than where we started. So that's sort of the issue of trying to time and move in and out. Is it's very hard to pick the best and worst days. Being consistent and methodical is generally the best approach. And it's usually when you have a bad period or really bad market days like we've been having, usually within the next 30 days, we get one of the best days because things rebound and the market sees purchasing opportunities. So I just wanted to share those videos with you today, and those slides, I should say, just a quick overview of how volatility works, why we're experiencing it, and then making sure that we're staying well spread, keeping on track with our goals, and making sure that we've got that medium to long-term time horizon when things go a little bit crazy as they're going. As always, feel free to reach out to us whenever you need to, only a phone call or an email away. Hope you're keeping well, and we look forward to catching up with you soon. Joel Seach, Harpel Financial Group. Thanks, guys.